Hi, good afternoon, everyone who is joining us, and good morning to those who are joining us from Europe. We are starting our webinar on sustainable finance, carbon markets, and AI. I would now like to invite Dr. Lim Jue, CEO of SGInnovate, to deliver his opening remarks. Jue, please.
Thanks, Todd, for the rescue. I didn't catch the cue at all, but a very good afternoon, morning, or evening, ladies and gentlemen, wherever you are calling in from. It's my pleasure to welcome all of you to our panel discussion today, Sustainable Finance, Carbon Markets, and Artificial Intelligence, which is co-hosted with the Embassy of Switzerland in Singapore. My name is Jue, and I'm the CEO of SGInnovate. I'll tell you a little bit more about SGInnovate towards the end. But let me just begin by saying it's an honor to open today's event alongside His Excellency Fabrice, Filliez, Ambassador of Switzerland to Singapore. Thank you, Ambassador, for joining us today. Just yesterday, Ambassador Filliez and I were at the opening of the Protein Innovation Center, a joint venture between Givaudan and Bühler, two prominent Swiss companies. This center intends to make alternative proteins mainstream through innovations in texture, taste, and aroma. Now, for me, when companies of the stature of Givaudan and Bühler take concrete action together in an area widely recognized as an important lever for decarbonization, it is yet another significant data point that the world has reached a tipping point in acknowledging that we have a problem and in its willingness to do something about it. Now, many countries have now announced plans to reach carbon neutrality, some as early as the 2050-2060 timeframe, as well as many intermediate goals before that time. Singapore is also picking up its own head of steam in sustainability. In 2019, our Prime Minister Lee Hsien Loong made the fight against climate change a national priority in a seminal speech. This was followed up as the Singapore Green Plan 2030, which was launched earlier this year. And as part of that plan, Transport Minister Ong Ye Kung launched last week the Maritime Singapore Decarbonization Blueprint 2050, which includes plans to create a global maritime decarbonization center. So that's how important that whole discussion is today. Now, critics may say you can make any number of statements about saving the world, but who's going to pay for it? Who's going to finance the changes and adaptations, large and or small, that are going to be inevitable with the ESG actions required to meet stated goals? So sustainable finance is a necessary condition for ESG action. And the good news is there are many encouraging signs. According to Definitive Financial Solutions, both the amount of sustainable finance bonds as well as the assets under management for ESG funds in 2020 doubled against the previous year. And according to UBS, the bank, investors representing more than 45 trillion in assets under management have already agreed to drive climate change action across their portfolios. So globally, Switzerland is a front runner in climate tech ventures, and its famed financial sector is already a leader in sustainable finance. And I expect that Ambassador Filliez has a few things to say about this, as well as Christoph Baumann, one of our panelists. They also launched the Green FinTech Network. Its mandate is to identify areas in which conditions for green FinTech in Switzerland could be even better and to cement leadership in the space. In Singapore, Mohanty is going to tell you a little bit about Project Greenprint. But in addition to that, they had announced, at the Monetary Authority of Singapore, MAS, also announced in March that they are going to place $2 billion with selected asset managers that are committed to deepening green finance activities out of Singapore. Significantly, it also recently published taxonomy proposals for financial services institutions in Singapore, which include a traffic light system that helps to classify activities as green or not green or less green based on their level of alignment with environmental objectives. Carbon markets are an important component of sustainable finance. By the way, it concretizes and monetizes substantive CO2 reduction, and by making it tradable. This paves the way for companies and countries to work across boundaries for global effect. The Singapore government recognizes this and has been making inroads into growing the nation as a leading carbon trading and services hub. So, for example, in 2019, Singapore launched the world's first digital exchange platform for airlines and other corporate buyers to trade securitized carbon emissions. But for sustainable finance and carbon markets to work, it needs to make good decisions. And in order to make good decisions, it needs good data. And in order to have good data, there must be transparency and governance. We need to know at the end of the day that one carbon credit was really tied to 1 ton of CO2 reduction, for example. So this is one complex exercise. And because of the sheer complexity of these issues, many solutions will necessarily be deep tech in nature. Over and above actual technological innovations that bring down carbon emissions, sustainable finance will increasingly depend on the integration of big data, artificial intelligence, mobile platforms, blockchain, and the Internet of Things to collect data, to collect good data, and then to make sense of it. And I expect Andrew might have a thing or two to say about that to me. Which brings us to SGInnovate in our discussion today. SGInnovate is a company wholly owned by the Singapore government whose mandate is to develop a deep tech economy. And we do this in a number of ways. We do this by investing in startups, but in early stage deep tech startups, by developing and placing talent, and by bringing people together like we are today. We believe discussions like today's serve to educate, raise awareness, and clarify our thinking. We also hope that there are precursors to eventual action, small or large, that collectively make a difference. Strong partnerships take commitment and mutual effort to build. Hence, SGInnovate is deeply appreciative of our partnership with the Embassy of Switzerland in Singapore. I take this opportunity to make a special shout out to Dr. Lawrence Glashaller, Science Counselor at the Swiss Embassy, for working with my teammates Tuan, to make this happen. My sincere appreciation as well to our moderator Claire, and to all our panelists, Andrew, Christoph, Christopher, Marion, and Mohanty, Osaps, for taking time off your very busy schedules to share your invaluable insights with us today. Last but not least, I thank the audience for tuning in. Now, if I may, let me invite the ambassador to say a few words. Ambassador Filliez, please.
Thank you. Ladies and gentlemen, dear guests and friends, it is a pleasure to welcome you today to this event on sustainable finance, carbon markets, and artificial intelligence, a highly relevant topic. In 2017, Switzerland ratified the Paris Convention on Climate Change, and in 2019, the Swiss government, along with many other countries worldwide, set the objective of zero net greenhouse gas emissions by 2050. Accordingly, sustainable finance, an evolution of green finance that takes into consideration environmental, social, and governance responsibilities, has risen sharply in the last couple of years. More and more, sustainability is shaping the financial market. In its recent financial market policy, the Swiss government reiterated its commitment to position the Swiss financial center as a global leader in exploiting the potential of digital technology in the area of sustainable finance. In this respect, we share similarities with Singapore. Singapore and Switzerland are global innovative technology hub in many areas, including green finance. We share a commitment to the UN climate goals, as well as to the UN Sustainable Development Goals. In other words, green finance is a natural focus area for both, and both are forging ahead on solid foundations. I wholeheartedly welcome this development. Collaboration between our visionary nations to lead sustainable finance may well be one of our most significant contributions to the future of our planet. The good news is that much is already underway. As we speak, a market is developing that aims at supplementing companies' efforts to reduce their own carbon emissions. This is the rapidly growing market for voluntary carbon credits. However, important questions remain. how precisely will carbon credits help companies to meet their climate change goals? What role will innovative technologies such as artificial intelligence play in improving transparency and trust in global carbon markets? I'm very pleased to welcome such distinguished panelists who will bring us the latest insights on all these questions. A special thanks to Mr. Christoph Baumann, Deputy Head of Insurance and Risk at the Swiss State Secretariat for International Finance, the SIF, my former employers, before I moved to Singapore. So I'm very glad to have them on board of this panel. Also, thanks to Sapnandu Mohanty, the renowned and well-known Chief FinTech Officer at the MAS, Dr. Christopher Kaminker, Head of Sustainable Investment for Lombard-Odier, based in London, Lombard-Odier being a front-runner private bank in sustainable finance, and I'm also very glad that they can be represented on this panel. And then Marion Wells, CEO of SustainCert in Geneva, as well as Andrew Glass, Head of Sales and Partnerships at Viridios Capital. The discussion will be moderated by Claire Langry, SAF, co-founder of 3 Pillars Advisory. So thank you all, and I wish you a very interesting discussion.
Thank you, Ambassador Filliez. Right, so we've all welcomed everyone. I'm Claire, your moderator for today, and I will start with just a few remarks. You're all on mute. However, we do encourage you to ask questions on our chat all along, and we will open up for Q&A after the discussion panel. The second remark is there will be a recording of this webinar available. So before handing over to all our panelists, I'd like to briefly redefine or define the context so we all start on the same baseline. We're all working towards curbing the sharp increase of the Earth's temperature and towards UN Sustainability Development Goals discussed at the Paris Agreement. To curb rising temperatures, we need to think multidimensionally. On one side, it is key for individuals and organizations to reduce gas emissions while also sequestering the gases that are already in our atmosphere. Most of the greenhouse gases stay airborne, but not all. Natural, biological, and chemical processes bring some of that excess back to plants, soil, or ocean. These sinks are nature's reservoirs for absorbing and storing carbon. The remainder gases stay in the air in abnormal levels, causing climate changes. Now we come to sequestering GHG emissions. That can be done by further tapping into the natural sinks or through man-made technologies. Now enter carbon markets. Reduction, avoidance, or sequestration of 1 metric ton of carbon dioxide or greenhouse gas equivalent is a carbon offset. And then carbon trade is the act of buying and selling emission reductions to offset a portion of the GHG emissions. For our webinar today, we have framed the discussion exploring why organizations should strategically include climate change considerations as a core responsibility. We will also go to how these corporations are supporting or are supported in their sustainability journey. And finally, the why, or the what, sorry, what technologies exist and what are the key enablers. So I turn straight to Christopher, and I ask you, Christopher, to briefly introduce yourself and start with one question, which is why should corporations actually strategically include climate change considerations as a core responsibility in their, and the second question is, why would they include credibility, integrity, accountability, and transparency as key to achieving the common goal?
Great. Well, thank you very much indeed. And it's a pleasure to be here. And thank you to the ambassador for those comments. And most importantly, we are a Swiss asset and wealth manager investing in global markets, but have a profound interest in Singapore. And I have quite a few colleagues there active on the ground. focused on sustainable investment. And as you may also know, we are a bank that focuses very much on technology and innovation. And so it's a real pleasure to be here. So thank you very much. So to address your question, perhaps less important to introduce myself and my team, but we do have a team at Nombarodier focused on sustainable investment research, strategy, and stewardship. And we have quite a few data science experts in the team. We even have geospatial analysts because we are approaching this from the perspective of a fiduciary. And climate change for us is all about risk and return. And it's for a pretty simple reason. When you look at the scale of the risk that climate change poses to the financial system, I mean, just have a look at what Swiss Re said, another Swiss firm, the other day. By mid-century, we could lose up to 20% of our GDP from climate change if we don't take action on mitigation and adaptation to climate change. But on the other side of the coin, it's possibly the largest wealth creation event of our times. We've calculated using official statistics, the OECD, the IEA, and others, that the transition to a low carbon and climate resilience economy is worth around $5.5 trillion per year in investment opportunity. So that's why we think corporations should place climate change considerations at the center of their business, and not only in the harder to abate higher carbon industries, but we think this is relevant for all industries. Everybody has to decarbonize. And the reason we see this as being so central to corporates and to governments for that matter is because of this powerful set of forces that we see churning away at the moment. And we have governmental and regulatory forces, and we've seen a huge shift just over the last year. Last year, 1/6 of the economy was covered by a net zero pledge. But as of Thursday last week, after the large White House summit, we're closer to 80% of the world economy covered by some type of a net zero target. And targets are great, but you really do want to see targets followed up with action, with quantitative midterm targets, and also the policy, the regulation, and the action that is needed to achieve a lofty net zero ambition by mid-century. So this gets to your point about transparency. You know, what is it that governments and companies can do to explain to the market and to allocators in global markets how well or poorly positioned, frankly, are they for this creative destruction that is going to sweep across industries and markets over the next 30 years, but will be front-loaded in the next 10. And here we use the Oxford-Martin principles. These are a very simple set of principles. They're just 3 questions. Do you have a net zero target? And do you have a quantitative midterm target by 2030? And then finally, do you have a business model that is going to be profitable on the direction of travel to net zero? And here we also get into the point of carbon markets, because there are good carbon offsets and there are less good carbon offsets. If not used appropriately, carbon offsets can constitute a form of greenwashing. So we also use another set of principles there to try and help us to understand whether the offsetting that is being incorporated by companies is plausible offsetting, is transparent offsetting, and has high integrity. I'm happy to talk about those a little bit later. And then the final point is artificial intelligence. Technology, data science is a real source and engine of transparency here and innovation. And we embed it deeply in our processes. So as I said, we're using geospatial intelligence to assess physical risk, how well or poorly aligned industries are to multiple physical hazards. And we're also using it to complete the carbon emissions picture of a given corporate. So if a corporate is not disclosing scope 3 climate emissions, carbon emissions, we will calculate those and we will engage with the company and we will ask that company whether they're correct if they're not disclosing it, and they should be under the TCFD. So this is a role for investors as stewards of capital to actually engage with companies around their transparency and how well or poorly positioned they are for this challenge.
Thank you, Christopher. Would any one of the other panelists like to comment on this question or add? I don't see, no. Okay. All right, so then let's go straight to the how. So basically what we were thinking is both Singapore and Switzerland have released their Green Action Plan earlier this year, as we were saying earlier. What the question to Subnendu and to Christophe, we'll start with yourself, Subnendu, is what mechanisms do your finance authorities have to improve the framework conditions for companies on their sustainability journey right now? And tell us a little bit more about where you're at this point in time, including the challenges.
Okay, thanks for having me. By the way, I just observed that almost 80% of your registration that chose to show up, which shows the quality of audience you have in this particular event. Well, as you rightly said, that we have laid out our plans. And Dr. Lim actually gave most of the plan away in his opening speech. So let me frame this in a different way so that we get the big tech construct behind this. We have a frame, we call it 5T, that get the taxonomy right, build the technology, create the transition to green assets, execute the transfer to green systems, and tax the remaining brown assets. So that's how we look at the whole green finance from a framework perspective. As you know, Asia is at a very different starting point from Europe, because here many millions of people don't have access to electricity, and fossil fuel still is the cheaper form of accessing those energy. And while it is a challenge in Asia, but it's not a bad situation, because if the technology behind energy becomes efficient from alternate sources, they can leapfrog and don't follow the usual path of consuming fossil fuel. I think that's one part. So what Asia is going to see a very transitory structure, which means many shades of green till you get to the end point, because the socioeconomic trade-off is quite complex. It's hard to believe that we're sitting in Singapore, I will solve a challenge in India, Indonesia, where the basics challenge are quite different. It's not as affluent as Europe, where you can afford to make a green call at any point of time. So there has to be the transitory structure to allow that shift to happen. So that's one context I would like to set when you think about Asia, the whole construct about green. Now, particularly what MAS is doing is we are trying to build in a two structure. First thing, can we develop a platform where we can customize solutions for Asia's need? One. Second, can we be the channel, as Singapore is a finance capital, to meet the Asia's transition need? So we have a platform which we have started putting together. It's called the Green Print. What Green Print does, it is designed to be a public good, where three key components are being structured. One, there's a marketplace where anybody solving any Asia's green transition requirement can look for investment from investors. So it's a marketplace to raise capital for your green tools. Also, is a marketplace to raise capital for SMEs who are looking to transit through the green structures. That's one. Second, large part of our challenge would be that once this green finance are disbursed, how do we monitor this commitment? Which means that there's a whole set of tech stack to be deployed in Asia, starting from IoT devices, decentralized data hubs, agreeing with different jurisdictions to pull data, and able to build a set of APIs, which I think many private players, include the people who are going to use as a data source for carbon offsetting or carbon market, can use these APIs for measuring the commitment made by the people who are tapping into the green finance. That's the second piece. And the third set of infrastructure we are going to build is to monitor the impact. Well, once you put this structure in place, once you do this measuring, how do you monitor the net benefit or the targets we are trying to achieve, or the direction of the flight where we are taking? Are you reaching the destination? That's the three big construct. Underlying that, we're also building a public good called kind of a hybrid data structure, where we will source different data which will drive this outcome. Just to close my intervention here, one data point we observed as part of our own research, that within the finance world, only 10% of the data we require for measuring this ABC I articulated sits within the financial sector. Remaining 80 to 90% of the data set sits outside the finance, whether they're from the logistics sector or they're from the food sector, hospitality, travel industry, utility. We're going to need an architecture to pull this data set, prepare the baseline data construct so the different E part of the ESG can be computed and hence provide the necessary foundational infrastructure required to drive the carbon offset or carbon market demand, which we need to build a sustainable structure behind it. So that's the broad construct. While we continue to put this program in place, we're hoping to see the first glimpse of this platform coming by end of the year.
Thank you, Satnandu. Christoph, you're busy writing.
I'm busy writing notes down from this very interesting intervention. Thank you very much also for the invitation to this webinar. And maybe to give you a bit background to Switzerland's approach to improve the framework conditions for sustainable finance. As the Ambassador Filliez mentioned, the Swiss commitments for 2030 and 2050 carbon neutrality until 2050, they translate into very high ambitions for the financial market as well. We do believe we want to increase the leading position we have in sustainable finance, and we believe that we can only do that if the financial market can make an effective contribution towards climate change and other sustainability factors. We do see three pillars how to achieve that from a government perspective. The one is carbon pricing. We think it's a key instrument that in asset prices, the pollution is adequately priced in, especially when it comes to carbon and greenhouse gas emissions. And to that degree, Switzerland nationally also has already the world highest carbon price with around $105 per ton CO2 emitted. And we do further try to increase that nationally. We also are engaged internationally to further discussions to have a global carbon price. In that regard, we believe net revenue neutrality is key. We believe that it shouldn't be a way to have an additional revenue stream. It should be a way to really funnel it back to the society, to have the backing from the society for such a price. The second pillar is transparency. I think it's already mentioned by Christopher as well. It's key that financial market has full transparency on carbon, be it from the real economy. In that regard, we are actively working to introduce mandatory legislation on TCFD, on Task Force for Climate-Related Financial Disclosures, to really improve the disclosures on climate risk and impact. The second one is that we actively work together with our financial institutions to have them disclose their alignment with climate goals based on PACTA methodology that's internationally developed. And the third one is that we engage with the financial industry on how to increase the transparency on financial products itself, to combat greenwashing, to really allow investors that invest in these financial products to make a good decision on what impact, to make a good decision to fulfill their desires when it comes to their investment decisions. The third pillar is, as already mentioned, green fintech, and we believe it's a huge enabler for the financial market in itself. It really enables it really can shape the way the data is available. It can really promote or help financial institutions take on a leading role. And in that regard, we initiated the Green Fintech Network that developed the Green Fintech Action Plan. And it really focuses on how to build the data foundation for fintechs to strive. That's why I've been writing down notes based on what my previous speaker has been saying. Other actions go much more into the area of how to ease access to clients and capital. And third one's also how to support new startups. So it's really, we believe we already have quite an engaging ecosystem on green fintechs within Switzerland, but we also do believe that there's still a long way there's still a lot of potential to improve that. So I think these are the three pillars that I wanted to mention, where we really have a focus on, and from CIF perspective, but also from the government as a whole. Thank you very much.
Hi, Claire. You're muted.
Sorry. Thank you, Christophe. On the aspect of SMEs and startups, the support you were mentioning, how does Switzerland support and encourage SMEs and family-owned businesses, which are a large part of the economical presence, to participate in the common goal to curb climate change?
I think there are two aspects I would like to mention. The one is already mentioned by Christopher before. It's really building awareness that this is also a huge business opportunity. It's not just about getting your risks, getting an awareness of the risks that the business has towards climate. It's also an understanding that this transition leads to a lot of opportunities for businesses, and especially small businesses are usually very agile to take these opportunities to reap the benefits of such opportunities. And the other one is already mentioned also with when you look at small businesses is the area of fintechs, which already mentioned, or startups in general in this sphere, which we try to promote with the Green Fintech Network, for instance, but also with, for instance, with the Technology Fund, which is funded with the CO2 tax I mentioned previously. So we really try to promote this ecosystem for small businesses to strive. When it comes to transparency, I mentioned the TCFD framework. Obviously, they target mostly larger companies, but we also believe that there is an area where we can help build awareness for such disclosures also for SMEs, especially that for lots of financial companies, the SMEs disclosures for SMEs is really important as well. I think there we try to help with recommending these disclosures to SMEs, and there's potential other measures we are developing this year to really support them in their endeavor.
Thank you, Christophe. Swapnendu, what is your view? SMEs are 70% of the regional GDP.
Yes, in fact, in Asia, it is much bigger. It's close to 80 to 90%. I think your point is very valid. Let me put this in a much larger context. I think the behavioral shift will happen if the supply and demand behavior changes. Let me explain this. Because a lot of our behavior depends on the behavior of community, individuals, who are the market participants, as well as the service provider, the companies themselves, as they serve this market. And both this behavior has got a lot of data which has to be captured, processed to do three things: how to predict a behavioral shift or potential bad behavior, how to prevent, and how to incentivize that behavior if it is in the direction you want it to go. So there's a need for structuring finances to shape that behavior. There's need for a lot of technology, especially the AI technology, which will allow this predictive prediction and the prevention part. And also, a lot of the data set which requires us to change the SME behavior comes from the behavioral and the spending data of this economy. And how do we process the data? How do we interpret? In fact, one of the challenges we are facing today is on the data itself. And there are three technology challenges we are facing dealing with SMEs. First thing, are you getting the right data in a digitized form, in a dematerialized form? Because very hard to execute this shift by looking at physical construct. It has to be digital data so that we get the access to data. Second, data portability. It's very difficult for businesses and individuals to start putting from data from multiple organizations we deal in our life. Can we pull all the data set and put it together and give it to somebody? Please process the data, and here is the my carbon behavior, and give me some carbon points I can use for something else. That has to achieve. And third, there's a policy barrier also, because many of the countries don't necessarily has the right policy framework to share the data because of privacy concerns, because of state issues around the sensitivity around the data. So there are these policy barriers which prevent this facility to look at the data, which can turn out to be an opportunity for us to change the behavior. So in the short, opportunities are huge. The small businesses do see that most of the financial sectors, due to the regulatory directives, are going to see a lot of finance requiring us to adhere to green standards. Hence, that shift will take place.
Thank you, Swapnendu. So onwards to once the GHG emissions are reduced, the carbon market helps offset the residual emitted carbon. Marion, how do you see carbon markets? What is the main mission of a certifying body such as SustainCert, and how do you see carbon markets?
Thank you, Claire. It's a pleasure to be back in Singapore, at least virtually. I used to come to Singapore very often when I lived in Cambodia, and I was always impressed by the innovative capacity of the Singaporean ecosystem. So it's great to be with you all today. So indeed, Claire, I'd be happy to talk about the role of offsets in the journey to net zero. I'll also touch on the role of a certification body like SustainCert and how technology can be leveraged to overcome some of the barriers that we currently face. So starting with the role of offsets, and before going into the details, I think the key message that needs to be shared sort of loud and clear is the fact that offsets role is changing now that we've entered the Paris Agreement era. We're no longer in a Kyoto world, and the Paris Agreement is changing a number of things, but two things in particular. The level of commitment in the agreement is to get to net zero by mid-century. It's no longer a commitment to absolute emissions as in the Kyoto time. And Paris also covers literally every country on Earth. So it's going to be very difficult to identify mitigation opportunities that fall outside the scope of the Paris Agreement. And so those two changes in paradigm mean that offsets need to be used in a different way going forward. From a net zero perspective, I think we're all clear that net zero, the journey to net zero has three pillars. So it's first about reducing, first and foremost, corporates and even individuals. We all need to operate businesses and live a life that over time becomes aligned with the 1.5 degree target in the Paris Agreement. So that is the first pillar of net zero. The second pillar is to achieve by the net zero date that is set by corporates on a voluntary basis or no later than mid-century. By that date, it's important that any residual emissions are neutralized. And that concept of neutralization is new and relates to the enhancements of carbon sinks. And those could be natural carbon sinks, or those could be technological carbon sinks. And the third pillar to net zero is really the compensation pillar, which we use to call offsetting, and which offers corporates an opportunity to compensate on an annual basis their residual emissions whilst being on a journey to net zero. And so offsets play a pretty big role in that third pillar, but they can also be used in the second pillar when offset projects are sequestration projects like reforestation activities, also direct air capture, for example, where those offsets would be called, for example, contracted removals or contracted sequestration tons, and could help corporates achieve their neutralization target under the second pillar of their net zero journey. So we're really seeing a paradigm shift in the way offsets are being used. The other shift that is being pushed more and more by civil society, including the World Wildlife Fund for Nature or the Science Based Target, is a change in the way the volume of offsets is estimated by corporates. To date, there was this approach where a corporate would offset as many tons as there are residual emissions. So it was a 1 ton for 1 ton approach. This approach has been criticized because of the very low price of offset, because carbon markets are currently still slightly oversupplied, and they are sort of flooded by very cheap offsets. And this exposes corporates to the criticism of buying themselves a cheap way out. And so the alternative that is being put on the table, and which I think needs to be considered or discussed, it probably needs some refinement, but the alternative is to say, okay, look at your residual emission on a given year, you multiply those tons of CO2 by a social cost of carbon or by your internal carbon price, and that gives you a dollar number that you should invest in reducing emissions. And here the volume of offsets that is being funded by a corporate is no longer determined by the volume of their residual emissions, but by the investment cost or by the cost to society that those residual emissions have. And so that's a really interesting other paradigm shift that I wanted to raise today. The other and final comment I'll mention on the role of offsets is directly linked to the nature of the Paris Agreement, which covers literally every country on Earth, and the nature of nationally determined contributions that countries have committed to. It's really difficult to identify whether an offset project is included or not in a country's NDC. And for that reason, we're going to end up in a situation where in the market, there will be two types of offsets. Offsets that will have received a corresponding adjustment by the host country. Those offsets will be eligible, for example, to the aviation compliance scheme, and offsets that will not have had received a corresponding adjustment for the host country. And so those two types of offsets are and will continue to be clearly differentiated in the registries of voluntary carbon market standards, like the gold standard registries, and they will hold different claims. The proposal that is on the table by the gold standard, which is supported by the WWF and other civil society organizations, is to say that if an offset has received a corresponding adjustment by the host country, then it can unlock a carbon neutral claim by the corporate that has purchased it. If the corresponding adjustment hasn't been made, then the corporate that has purchased that offset should switch to a climate finance claim and should communicate on its financial contribution to reducing emissions in the host country, but should not be entitled to making a carbon neutral claim. So we need to be aware of those distinctions and realize that going forward, offsets will be of different nature. And depending on the nature of offsets and whether they have received a corresponding adjustment or not, the claims that can be made by corporates will need to change. So that was on the role of offsets. Briefly on certification and why it matters. As a certification body for climate security and sustainable development, our role is to break down barriers to making credible impact verification mainstream. And right now, impact verification in the context of carbon market is probably one of the few sectors that has been left completely untouched by the digital revolution. We still see auditors go to the field to check that wind turbines are really running, to check that household devices are being used. There's a lot of manual work, paper-based work, and that creates obviously delays, really high cost, but it's also suboptimal from a quality perspective. So our goal at SustainCert is to leverage technology to make the process much more efficient, much more accurate as well, and to reduce timelines. So we operate the only digital software that allows a project to issue carbon credits through an online software. And with new technologies such as Internet of Things, we'll be able to automatically collect monitoring data from renewable energy projects, from household projects, or even satellite imagery from forests that are being planted or monitored, and thereby significantly enhance the quality of the monitoring data, the quality of the offsets that are being certified, and the overall integrity of the market. And this is where I do really see an important role for technology. There's a lot of emphasis right now on what we would call the downstream part of the carbon market ecosystem, where startups are focusing on using technology to simplify the trading of offsets and the commercialization of offsets. We believe that there's an equally large opportunity on the upstream part of the value chain, which is really the data collection, the greenhouse gas algorithm, and the verification process that underpins the creation of a carbon asset. And so that's what we're set up to do. And we're really excited to see all the momentum in the broader sustainable finance space, because we believe that the infrastructure that we're contributing to create for carbon markets can be easily leveraged in other sectors in the broader sustainable financing landscape.
Thank you, Marion. Very complete coverage. Tagging on to that, Andrew, what is your view on the use of technology in your area? And can you please introduce yourself and Viridios?
Thanks very much, Claire, and thank you everyone for the opportunity to contribute and share and learn together. So I think Marion phrased and encapsulated very well. So where the industry is at, or the ecosystem is at. And what we sort of kind of done at Filliez is we're a group of a team that's come together primarily from financial markets and commodity markets, and seen that there was the problem statement, I suppose, that we looked at really was transparency in the pricing of the voluntary carbon markets. So what actually is a project worth, and how is that communicated throughout the ecosystem and all the participants, whether they be developers, whether they be end buyers, whether they be traders in between. Because what we look at is we look at the ability to embrace and diversify the market to include the capital markets as much as we can, and the power of those capital markets to bring price transparency and eventually also to move the price. As was mentioned earlier too, a lot of nature-based solutions are really not where they should be priced right now. They're far too cheap. They have a significant amount of SDGs embedded in them. So not only are they sequestering, but they're also got a lot of SDGs embedded in them. And for us, really, I mean, the certification companies, just as SustainCert, are absolutely critical enablers and critical pathways to driving the inclusion of those capital markets, because we have to have credibility and we have to have the integrity that they bring to the whole ecosystem. So it's absolutely pivotal to the future. And then organisations, governments as well. I mean, what we've heard both from Christoph and Mahanti about the support that we're getting from governments also help on that diversity and inclusion, which is going to bring more transparency to the market and accountability. So, but just to go on with that, so what we've actually looked at then is that we've taken over 20,000 data points of transactions actually made in the voluntary carbon market, and we've used AI technology, machine learning and neural networks to effectively work out and to learn the taxonomy of each transaction, which can be divided into 5 contributing factors. We have the standard, we have the geography, we have underlying project, we have the vintage, but we also have SDGs importantly as well. And those SDGs that are certified, and again, we come back to this certification because that's, you know, everyone's got a role in this ecosystem, and we have to rely on the certification, and we believe in the certification, same as what we would in bond markets. If we talk about Moody's, for example, when they give a rating, and this is, again, critical pathway. But then from that, we're able to also understand transparency in financial products. That taxonomy, then using those neural networks, we can understand and value current markets and every single sort of project that's out there. What we're also doing is we're bringing to the market, which should be available in May, June, is new indexes. And that's going to give a benchmark for the whole industry to look at in reference to particularly how they develop relationships and pricing on everything from renewables, soil carbon, and then different forestry products and also household devices.
Thank you, Andrew. So we have reached 4:50. What I'd like to do now, because we have a few questions in the Q&A, is go to Q&A before we come back on our one wrap-up question. And I'll start with the first one from Long Jiang. His question is, I understand the construct of the carbon trading platform. I'm curious how it is being worked on. Is MAS doing it in-house or collaboration with private sector? So I guess this is addressed to you, Satnendu.
Yes, I think we're going to soon open up the platform for inviting private sector to participate. We are in the process of building the different use cases which will drive that outcome. So maybe in a month or so, we'll see the public domain. Especially, I think the question is around the marketplace, where we will be looking for specific solutions to come together to drive for certain sector green solutions. So that will be so again, MAS has put together a $50 million grant specifically supporting the tech innovators who are in the space. So that's a grant also available as we speak.
Thank you. There's another question addressed to you, Andrew, which is about the sources of Viridia's 20K data points, where the data comes from.
Sure. That data is, look, I mean, there's not really an exchange out there yet. It's definitely been worked on. There's one here in Singapore called Air Carbon. They believe in building tokenization, distributed ledger technology. So that's going to give us a lot more transparency on an actual exchange regulated by the MAS. There are some other ones that are coming, so that's good, and we'll be able to pull those data points. But the data points we currently use from OTC transactions, and they're all generally bilateral. And this is part of the problem statement we came up with as well, is that there's just not the transparency in those. A lot of those are transacted under NDA as well, non-disclosure agreements. So we've managed to have those conversations with those participants in the market, and they've shared that data with us, because they believe in the value of the transparency and how this market's going to evolve. So yeah, they're very much derived from OTC transactions since 2012, but they really, the majority are since 2016.
Thanks, Andrew. There's another more general question on the international harmonized calculation of net carbon emissions. What is it, and what's the calculation methodology, such as including importing, logistics, etc.? Who would like to take up this question? So the question is, what is the international harmonized calculation of net carbon emission?
I can have a go at this one, Claire. I would say that the international, sort of the leading international standard for greenhouse gas accounting is the Greenhouse Gas Protocol, managed by the World Resources Institute. It doesn't use the term net carbon. It's sort of looking at greenhouse gas emissions from a scope perspective, scope 1, scope 2, and scope 3. So it's a method that allows a corporate or even an individual to account for their emissions in a comparable way across the board. So that would give you perspective on your carbon footprint. And when it comes to net zero, I think the framework that is being developed by the Science Based Targets is set to become one of the leading sort of benchmark for net zero. And this is where the 3 pillars that I was talking about earlier come in. The first pillar being reducing. So this is where you calculate your footprint and work to reduce it. The second pillar being neutralization, enhancing carbon sinks. And the third pillar being offsetting, compensation.
I'm assuming the complexity of this question is when we talk about service company with a large supply chain management, and as soon as you start looking into scope 3, the complexity is very high.
Yeah. Maybe I could just layer into that response there. And, I'd be happy to associate myself with with Marian's response there. That is also how we look at it. There are other pieces to the puzzle as well, where we haven't yet seen international harmonization, and it might be worth just mentioning them. So there is the notion, of course, of scope 4 emissions. In other words, avoided or saved emissions, which has not yet been harmonized or even, I think, very far advanced by the Greenhouse Gas Protocol. But it is an important calculation nonetheless, because you can have a company which has a large carbon footprint and it is in the business of manufacturing something or selling something which avoids or saves or reduces emissions somewhere else in someone else's scope 1, 2, or 3 emissions. So that's an important number for us as investors to know, and we've developed a system to try and account for that. We set it alongside scope 1, 2, and 3 because we have to be careful not to conflate avoided emissions with actual emissions reductions that need to be done by the institution itself. But it is nonetheless an important number to be aware of because it shows you the potential upside market opportunity that exists there. And you could also argue that there's scope 5 emissions or other forms of emissions which are very, very indirect, but nonetheless important. And some people talk about these as climate lobbying. So lobbying against climate action, which could be associated with litigation risk and liability risk under the frameworks that central banks look at. So there are other pieces to the puzzle as well. And that's why we as a financial institution have tried to create a system, a methodology internally to understand not just what is the carbon footprint of a firm, but also what is it doing about it? What is its direction of travel? And Christophe was alluding to these type of measurements, which can be referred to as implied temperature rise metrics, which calculate whether a company or a government is pulling its fair share of the emissions reductions needed in a journey to net zero. And that we think is an important measurement as well.
Thank you, Christopher. I'll go straight to the other question from Andre, which is how about the countries' collaboration between Singapore and Switzerland. Question being, how do Singapore and Switzerland collaborate to advance the global sustainable finance agenda, considering that this is a global issue and not limited to a single country, of course. Would you like to take the question, Christophe? And
yeah, sure.
After?
Take a start. So I think there's numerous initiatives internationally. The multinational fora are really filled with sustainable finance topics. Just to name a few, you have the central banks and supervisory authorities who are active in the Network for Green Financial System. You have the Financial Stability Board, who is very active on climate risk in particular. IOSCO is active on disclosures. And you have new initiatives like the Coalition of Finance Ministers for Climate Action that have much broader members where the topics is much more focused on how to support other countries in their NDCs and building up disclosures. You have the IPSF, the International Platform for Sustainable Finance, who's really looking at the different jurisdictional approaches to disclosures and taxonomies. So it's very confusing at first when you look at all these initiatives. And gladly, I see over the last couple of months converging, a coordination of these initiatives. And I think to a large part driven by, on the one hand, the FSB, but also on the G20. I think the re-establishment of the Sustainable Finance Working Group, as co-chaired by the US and China, is really bringing a new momentum in this coordination of these international initiatives. They're currently working on a roadmap over the next couple of years that really should define the topics that are important for the various international organizations to work on, and they're trying to have a certain coordinated role. I believe that's very important. It's especially important since there's a lot of work going on in parallel on disclosures. For example, you have the IFRS, who's working on standards based on TCFD. That obviously that Switzerland very much supports. But at the same time, countries like UK and Switzerland are already working on mandatory implementation of TCFD. So how to ensure that at the end there's a comparability across jurisdictions, and that's, I think, one of the key challenges we're currently trying to address. and where we're very thankful for working within the G20 to address these.
So I will give a very 1-minute response, just 1 minute. Switzerland and Singapore are not the change maker of green finance. The real change makers are poor countries who needs this finance and the tools to make that change. We are just an enabler of the process. We are to ensure our role as a global finance hub to direct the capital we have to these sectors, to this country, so they can make the ultimate change we're looking for. That's our role. Our role is to be the facilitator, not the change maker. The change maker is sitting in small villages, towns in India, China, and ASEAN countries in Asia, also Africa and Latin America. They are the change maker.
Thank you both. Thank you, Zubnandu. Another question from Michelle. What are your thoughts? This is addressed to all the panel on the 2050 net zero goals. Switzerland and Singapore are the first world countries, but what about the not so fortunate countries? Zubnandu,
I just alluded. Yes, exactly. That's where the real action is. That's where the real challenge to be solved. We got to come out of our developed construct and go to this market, work with those people on the ground, find a socioeconomic trajectory process to get them to the green impact we want to make.
But what are the roadblocks to get there?
I think roadblocks is in multi-layer policy, of course, infrastructure, redirecting finance. They're all in different layers, but we should not, while taxonomy is important, but I think we should also start looking at that path to shift. Now, I'll give an example. We can create the best taxonomy. We can redefine our green finance, but somebody to shift at factory, what they're producing today, to a sustainable factory, we need technology, we need solutions which is affordable. There's a whole set of work to be done, work in progress. The capital has to go there first. Get the tools you require to shift that outcome. And unless you get there, green finance taxonomy has no meaning.
Thank you.
And if I may add, to me, one of the key roadblocks to more ambitious climate policies is public acceptance. And I think there's still a long way, a lot of improvement we collectively can make in communicating the message that ambitious climate policies are good for the people because they will create new jobs. They're good for our collective health, on top of being good for the environment. And I think if we can spread that message much more strongly, that ambitious climate policies can create a world in which everyone will have the opportunity to strive, where everyone will have access to health and basic needs, where we will collectively be able to deliver on the Agenda 2030 for development, then public acceptance will rise, and then we'll have the policies and the private sector momentum required to overcome the challenge.
Just quick to Marianne's point, she made a very beautiful point. I think I will repeat this. If green finance can create income equality, there's nothing like that. Get it right, green finance will be the natural shift.
This goes with capability building. Going on to another question, which is on initiatives. Most initiatives focus on government, enterprise level action. How do you foresee regulators like MAS or FINMA deploy regulation that involved end consumers and the traditional retail audience?
Oh, that's a very difficult question.
Yeah.
There's still there's a path to that. In fact, we have announced some of our intent on public consultation on the whole thing. But yes, we have to still a lot of work to be done. I defer to my colleague from Switzerland to reflect his views.
Yes, same here. I think there's a clear need, or the government acknowledged a clear need to address transparency on financial products for end consumers, to avoid greenwashing and to really give the transparency the investors want. We initiated a working group on government level led by CIF that are assessing the various actions we could take together with FINMA. There's obviously the developments within the European Union with the Sustainable Finance and disclosure directive that are of key interest. But I believe it's really important. Switzerland is really coming from the angle that the market will act if there is transparency in the market. So our first priority is to ensure transparency, not just on institute level, but also on product level. So I think it's a key priority for us to ensure the end consumer has all the information.
And the product level should be end-to-end. It should be from the supply and production to the end point, not only consume at the end point consuming level.
Christopher, did you want to add anything to that?
So maybe I could just build on some of the comments there, especially what Christophe just said. Regulation and government, these are very fundamental forces for sure. And we've heard about carbon pricing, we've heard about disclosures, we've heard about policy ambition. There are many sets of regulations that are influential here. But for us as private sector investors, we also spend a lot of time thinking about market forces. And here we've had hints about the power of market forces and innovation. And this is really where we think the driving seat is shifting to at the moment. It's market forces. Let's just take a moment to reflect on some of the stunning cost declines that we've seen in all sorts of climate technology, ranging from onshore wind and offshore wind to solar PV, lithium-ion batteries, hydrogen electrolyzers, all alternative proteins. All of these technologies have faced these incredible exponential ramp up in productions and associated costs down in their curves. And these experience curves, engineers are smart and they keep on shaking out the costs of these technologies. And what we see there is that the market has this ability to pull forward a transition, because if the regulatory framework is clear enough, the market will move to seize the opportunities there, and production at scale, economies of scale in action, all of these somewhat tedious microeconomic forces really create the tipping points that we see in the system. And right now, the mobility sector is caught right in the middle of all of these forces, because you've got policy, you've got market forces, and you've got consumer demand and investor forces, and they build on each other. As the cleaner option becomes cheaper, or as it comes close to becoming cheaper, adoption increases, capital starts shifting, and it's like a flywheel. It turns, and this is what we see the climate transition as being.
Thank you, Christopher. A question that I think most of you could answer is around the risk approach. The question is, what are the high risks and challenges that such new fields bring financially? Or put differently, what are the risk of market inefficiencies and the possibility that the new liquidity and injection could drive a new bubble in the green investment? Who would like to take this question, sorry? Andrew, would you like to share your view?
Yeah, sure. I mean, we look at it from the point of obviously price transparency and the risks to businesses. And I think if we sort of talk about a little bit about what Marianne also talked about earlier too, that first and foremost is about reducing your own footprint for businesses. Now, if the price of carbon is to be transparently shown, carbon offset market, particularly in the nature-based solutions, if that price starts to go to where it should go, and where there's been a lot of predictions where it should go into the triple digits, then that's going to spur also a change, because the cost of actually offsetting to meet your net zero is going to become that much more difficult to justify from a budgetary perspective as well, right? So we believe in the transparency actually then brings it back to changing your behaviour and reducing as much as you can. And if you've got actually offsets sitting on your balance sheet, and with transparency in market and with indexes that can be valued against, the auditors of the world are now looking at it as an asset on a balance sheet. Now that changes the dynamics of how someone looks at it. If you're a company that's got offsets on your balance sheet and you're planning to retire them, and the price doubles, for example, then you get everyone in the room. You say, how the hell can we reduce our emissions of our own footprint as fast as we can? Because we want to hold on to these credits to expire against, or to retire against our footprint moving forwards. So it does, that transparency relates to a whole lot of behavioral changes in the exact direction that we want to go, in the primary direction we want to go, which is reducing the footprint. So yeah, it very much comes down to transparency in finance to drive the behavioral change, we believe, as well.
It's a great question, because I was just out of humor, if I can say, not as an MAS officer, which bubble is better, bubble behind crypto or a bubble behind green investment? So, so we got to see which is the right bubble to follow.
Thank you both. I'll take one last question, which opens up to the future. And the question is from Michelle. She would love to know from the panel, what do you think is the next? What do you think is next for sustainable finance, and what are your predictions and hope?
I may maybe take a step from a policy perspective. I think there are two next topics to watch over the next couple of months. The one is on taxonomy. You have the European Union taxonomy, obviously. You have the UK that's taking over a part of taxonomy. You have the Singapore, who just launched a consultation. So it's very interesting to see how other countries will position, especially the US, on this topic. And the other interesting topic, I would say, is the border adjustment carbon tax that's being discussed within the European Union, and that should be presented over summer. And that will ignite or reignite the discussion on a global carbon tax quite a bit, I foresee. And it's going to be interesting to see how serious they will position that mechanism.
Thank you, Christophe. Anyone else want to complement this?
What next question? The what next?
Yeah, the what next? Yes.
So I think, can I just deviate from all the good things we talked about? I think as an innovator in this space, I personally believe there's a completely different model to look at. It's called citizen science, which means, can we empower everybody in this earth with some kind of amazing IoT devices distributed, which can capture all the possible environmental data we have, push it to the cloud, run the AI engines, and kind of bring back the whole monitoring to a new level. As an example, my inspiration is from a non-profit organization called Safecast. After the Fukushima nuclear disaster, a bunch of people in Japan started carrying the little devices to measure independently environmental data, and they pushed it to cloud, and suddenly you saw the reporting and the actual data mismatching. I think that empowering every citizen with the device to push your environmental data where you sit can change the game of green finance and sustainability. Mm-hmm. In fact, it's lying on my desk a new device called AirNote, which I am going to put in my house to measure air quality near me, and it goes to the same public cloud.
Christopher, you wanted to add something on the what's next question?
Well, on the what's next, we really do think that it will be about natural capital, biodiversity, and other forms of nature-related assets. So, and we were just hearing about air quality. That is another form of natural capital. It's linked to climate change. Many aspects of natural capital are inextricably linked to climate change, but I think that we're going to see a lot more attention from investors and from the market, and possibly also from regulators focused on biodiversity, loss, deforestation, the quality and the stock of our natural capital, which really is the foundation for most of our economic activity.
Mm-hmm. Marion, did you have a view on the what's next question? What is your hope?
Yeah, I think that the hope is that we can really raise our collective level of ambition by growing public acceptance for those new policies, new regulations. If we can make sort of green finance and ambitious climate commitments at country level resonate with better jobs, more jobs, and better health, I think we'll be able to significantly raise our level of ambition and be on track to meet the Paris targets.
Thank you. Andrew, did you want to conclude on your hope and what's next?
Yeah, look, I mean, frankly, I think it's about accountability. I think all of these commitments to net zero, they're fantastic and they're laudable, that's great. But how many executives of these big organisations and board members will be still around to see through the commitments that they're making at the moment? And to go back to something that Christopher said earlier on too, is it's that accountability. And it's fine to have, I think we've got to have benchmarks, and those benchmarks need to be measurable, they need to be transparent, and they need to be accountable, and they should, on an annualised basis, they should be before bonuses are paid to the executives. There should be extra bonuses if they manage to overshoot their commitments on their trajectory to net zero. Board members should be held accountable as well before the AGM. I think the transparency really needs to be built in with regular, measurable, accountable milestones on an annualised basis. And I think that's when the faith in these commitments will be taken a lot more seriously by the population at large too.
Thank you, Andrew. Thank you to all the panelists. We've come to the end of this webinar, and we've had some great questions. So I hand over back to you at SGInnovate. You're on mute.
Thanks. Bye.
Yeah. Yes, thank you everyone for sharing your insights and perspective. And thank you, Claire, for your amazing moderation. And of course, we couldn't have done this without the ambassador as well as the Embassy of Switzerland and Singapore team for making this event happen. It is heartening to see our audience actively participating in the discussion through the Q&A box. So we would like to thank our attendees for tuning in and for your great questions. We do hope this panel will spark more discussion offline and actions and commitment to account for a better sustainable future. We will be sending a post-event email with the recording to the session and ways to connect with our speakers. So let's connect with us on various social media channels on the chat box and on your right. And we hope you have a great day ahead. Bye-bye.
Bye-bye. Thank you.
Thank you, everyone. Bye.
Bye.